Everybody, what's going on? How are you? Derek Nelson here. I am the author of a book called The Financial Foundation System, which is available on Amazon. Today, what I want to go over is 2 reasons why making those extra mortgage payments could be a huge mistake. Now, I know we all want to live debt-free. We want to get rid of that bill. I get it. But there are ways to do things, and there are ways to do things. So the traditional method, either you refinance and take a shorter term mortgage, which will raise your payments a little bit, or you just send extra payments to the lender in an effort to shave some years and interest costs off your loan. I understand why somebody would want to do it, but how you do it is very important. So first I want to go over the 2 reasons why it could be a huge mistake, and then I'll go over an alternative if you stick to the end. So, number 1, equity in your home earns 0. Okay, what does that mean? Your money that you have tied up in your house earns $0. This means every year that your money is tied up in your home, guess what? You're losing purchasing power. You're losing buying power to inflation. Your dollars buy less and less over time. Now, some would say, well, my home value will appreciate. Okay, so now you have additional dollars earning 0. You get my point. Yeah, capital gain, when you sell your home, you'll hopefully make money. But with that said, you're probably just going to keep that money tied up and purchase another home anyway. So that money is earning 0. On top of that, the amount of equity, think about this, the amount of equity you have tied up in your home has no effect on the value of your home. If values come down a little bit, you have a little bit less equity. If values go up, you have a little bit more equity. But whether you have 10,000 or 100,000 in your home, it has no bearing on the housing market, right? Now, number 2, you have very limited access to your money. What would happen if you suffered a job loss? Could you get your money? What if you can't work because of an illness or a major injury? You know, the number one reason for foreclosures in this country is due to medical bills. Plus, if you're not working, how could you even get access to your equity? How do you qualify? And to top things off, if you have a ton of equity tied up in your home, banks love that. They'll foreclose on you that much faster because at least they won't take a total hit on it. So now let's go over a real scenario where somebody is looking to actually pay that loan off early. They have a $200,000 mortgage. They're paying about 3% interest. At 3%, their payments would be $843.21 a month. Okay? Now, just keep in mind, I'm not including insurance or taxes. You got to pay that regardless. I'm talking strictly mortgages. Now, here's a solution. Okay, now if you just go and you make those payments systematically, $843.21 over 30 years, in year 20, you're going to have $87,324.11 as the balance. Okay, now let's look at it as if you were going to pump an extra $300 into your mortgage. By pumping an extra $300 into your mortgage, you're going to shave a little bit over 10 years off of a 30-year loan. So you get your loan paid off in 20 years versus 30. By the way, you'll save over $40,000 in interest. Not a bad deal. But again, go back to what I said. The equity earns 0, and what happens if? Life happens. We get injured, we become disabled, we get sick, we lose jobs. That all can happen. So let me show you an alternative. Take a look at this. This is a designed cash value life insurance policy. Now, what I did here is very simple. I took that same $300 that we could pump into our mortgage in an effort to pay the loan off about 10 years early. And I designed it here so we're going to pay $300 a month into a life insurance policy. Now, why would I want to do that? The number one reason why I want to do that is because I have control of my money. If I become disabled and get sick or lose my job, and if you go, let's go down to year 8, for example, there is projected to be just under $27,000 in cash value. Heck, if I need 5 or 10 grand to pay the bills for a couple of months, the insurance company's never going to ask questions. Good luck getting qualified with the bank. Plus, if you look all the way to the right, that's the death benefit. If the primary income earner passes away prematurely, well, that money can be allocated to pay the loan off. And then you eliminate that bill, and that's a tax-free benefit. By the way, it doesn't have to go to the mortgage. There's things you can do with that money, and that's the beauty of it, it's complete flexibility. Whatever the beneficiary chooses to do, wife, husband, kids, whomever, they can do as they please with that money. Now, but here's let's talk about paying the mortgage off early. Let's go down to year 20 in this life insurance policy, okay? You have now contributed $72,000. Your projected cash value is $108,510. Now, if you're going to have a balance, if you're just making your regular mortgage payments of $843.21, if you remember, you're going to have a balance in year 20 of $87,324. You can totally take the $87,000 out of your cash value life insurance policy and pay your mortgage off and be mortgage free. Guess what? It's your choice. You can have the choice. You could say, you know what? I want to pay the loan off. Or we're in a pretty good situation. I want to just keep building this nest egg and give myself a tax-exempt income or distribution in retirement. The choice is yours. So what the life insurance does that sending extra payments to a lender does not is give you complete control and flexibility. And by the way, with my way, you're guaranteed never to lose a dime. I hope you found this helpful. Reach out to me if you have any questions. If you're watching this on Facebook or any other social channel, please, give it a like, give it a share. I want to spread this knowledge. And if you got this on YouTube, don't forget to subscribe as well. You folks take care and you have yourselves a great day. So long.